Hey everyone, I'm Jake, and this is Money Mondays. So I thought I'd change up the format a little bit this week and tell you all a story. This is a story about international finance and money, and hopefully you can take a good lesson away from it. Now the story was inspired by Sir Isaac Newton, and he had a quote in 1720 where he said, "I can calculate the motions of heavenly bodies, but not the madness of people." Now in the early 1700s, England was at war with Spain, and they had been in a lot of wars at that time, so they had accumulated a lot of debt. In fact, England had £9 million worth of debt, and in 1700s, that's a lot of money. So much money, in fact, that they're still making payments on it today, almost 300 years later. Now England knew that they had way too much debt and they weren't going to be able to pay it off. And so they needed some way to get out of it without collapsing their economy. And so in 1711, they made a deal with the South Seas Shipping Company. And their deal was that South Seas would take over the debt burden of England in exchange for having a monopoly on all of the shipping routes between England and South America. Now the people of England saw this monopoly that South Seas had on all the shipping traffic, and they thought, wow, that's a great deal. They must have the ability to make a lot of money now because they have all of those lanes open to them. And so the people started buying up all the stock. And now there was a lot of fraud and insider trading going on at the time, but the people of England were also buying a lot of shares, and that propped up the stock price. So once the people of England got excited about the South Seas Shipping Company, they also got excited about all the other stocks that were available, and they became enthralled with speculative investments. And that just pushed the prices up even more. People were borrowing money to buy as many shares as they could. In fact, by August of 1720, South Seas stock price was up over 1,000% from where they were when they started. Now this is where Isaac Newton comes in. And this guy was a genius. He actually created calculus because algebra wasn't good enough to solve the physics problems that he was working on. Now he saw this run up in the South Seas stock price, and he bought into it. And he actually made a lot of money before he sold out. And after he sold out, he saw the stock price still rising, and all the people of England were still buying shares, and it was going up, and it seemed like it must have been a good deal. He was worried that all of his friends would be making money and he wouldn't, and so he bought back in. So he ended up buying back in right at the end of 1720, just in time for the crash. He ended up losing about £20,000 in the exchange, which is the equivalent of about $2.5 million today. So what lessons can we draw from what happened to Isaac Newton? Now the first lesson is that even if you're as smart as Isaac Newton, you're not going to be right 100% of the time. But that's okay. You just need to protect yourself for the times where the market might crash. Now financial planners like to talk about something called diversification. And that just means making sure that you own enough different things in your portfolio so that if one goes down, hopefully all of them won't go down at the same time. And now the next lesson is that market crashes happen. In fact, they happen fairly regularly in the US, about every 7 to 10 years. And now that's not meant to try to predict that a market crash is going to happen soon. In fact, I hate when people on TV try to predict crashes. We have a joke in finance that says when someone's bragging that they predicted that this crash was going to happen, they called it. And we say, yeah, but you called 10 of the last 5 crashes, which is just a joke that says you've been calling them so often that it doesn't really carry any weight when you're finally right, because it's just the random cycle of crashes that happen. Now the last lesson is to try to keep your emotions out of your investing. The most common thing that I see when people are losing money in the markets is because when the market goes up, they do exactly what Isaac Newton did. It goes up and they get excited, and so they buy more, but they buy at the top. And then it crashes, and they get scared and they sell out, but they sold at the bottom. And buying high and selling low is not the recipe to make money in the stock market. If you can invest based on the fundamentals of the company, meaning they have a good business model or they have the potential to make a lot of money, then that's really going to be better for your portfolio in the long run. So hopefully you got some good lessons from that story. And if you want to know more about personal finance and money topics, go to our blog at arbogasadvisors.com. Or you can watch more of our YouTube videos at youtube.com/arbogasadvisors. And if you want to know about a particular money topic, put it in the comments below, and I'll get working on that for one of my upcoming videos. Thanks for watching. Psychological change that happens when you take money out of a 401k account. Once you do it the first time, you're more likely to do it again in the future. You go from seeing a retirement plan as a long-term savings that you shouldn't ever touch to an account that you can just dip into whenever you need. And that's a dangerous mentality to be in. So